What is insurable interest? It is a legal requirement for a person to have a financial interest in the property being insured. An insurance company may deny a claim if it can be proven that a person does not have a financial stake in the property. Dealing with a property like a home or a car, the person who is seeking coverage needs to have ownership of the property. For the homeowner, ownership proof could be the name on the deed or mortgage. For the person that wishes to get insurance on an automobile, the title, bill of sale, or name on the car loan are some of the proof to show ownership of a vehicle. This is the most important part of any insurance contract and can not only make or break any agreed-upon terms between the insured and insurer but could also result in insurance fraud. Proving insurable interest. There are times in which the insurance company may require you to show proof of this. Some companies' underwriting policies may require that their agents collect a copy of it before covering a vehicle. Another insurer may request a copy of the title to make sure a vehicle is not salvaged. Not all insurance companies insure salvage vehicles, but if for some reason they believe the vehicle is salvage, they may require a copy of the title. The life insurance company will want the person who is taking out a policy to elect a beneficiary. The beneficiary must have an insurable interest, which means they will have to be financially impacted by the passing of the policyholder. At the time of the policyholder's death, his or her beneficiary may have to prove insurable interest. Before a life insurance company cuts a check, they must be sure that the person that is receiving funds is who they say they are. What are other examples of insurable interest? Examples of insurable interest can be the mortgage company that lends money to the homeowner to purchase a new home. The fact that the home is being financed by another entity gives the mortgage company an insurable interest to the property. Mortgage companies also have the right to place homeowners insurance on the property if the insured fails to keep coverage on the home. Also, think about the lien holder of a car note. They have an interest in the vehicle they are financing. The finance company of an auto loan has the same right as does the mortgage company. They can place insurance on the vehicle at the insured's expense. When does insurable interest not exist? An example of this would be Karen selling her car. Because she no longer owns it, she doesn't have the right to insure it. The same can be said about Bob, who sold his home in order to move to another state to secure a new career. Once a mortgage is paid off, the mortgage company no longer has an interest in the property, therefore the homeowner can have them removed from the mortgagee clause. Likewise, the auto finance company, once the loan is paid, the insured can remove the lien holder from the policy. Understanding the concept of insurable interest is very important. As mentioned, it can make or break the contract between the insured and insurer.